I'm Charlotte McLeod with investingnews.com, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for being here.
Thank you very much for having me, Charlotte. Good to see you again.
Yes, excited to talk to you about what's going on in the markets and with gold. And I think we'll start with the Fed. And if I am remembering properly from previous comments that you've made, we should be now approaching the point where gold really starts to perform. So I think you said it will move if and when the Fed cuts rates without properly curbing inflation. Seems
correct. Or what I actually said was, I think when the market believes that the Fed is going to cut rates without taming inflation, I think we're at a sort of, yes, we're at the pivot point, if you want, right now, because, you know, the Fed's not going to cut in January, but March, are they going to cut or not? It's 50-50 on the Fed funds futures. And I would put the odds at 50-50 right now, frankly. I think the gold market is a little bit ahead of itself in expectations for the number of rate cuts and how soon they're going to start. But I think on balance, I think things will change over the next few weeks, and I suspect we'll get a rate cut in March. Once the Fed cuts rates without inflation being quashed, then gold really starts to take off. And you can see that in the last, 4 or 5 examples where the Fed has started cutting rates. Gold really takes off. And let's not forget, the soft landing camp talks about how much inflation, CPI, it's not really inflation, different issue. But anyway, how the CPI numbers and the CPE numbers have come down. But let's not forget, even according to the Fed's own preferred measure, the measure they picked, core CPE, right, which means we don't eat and we don't go anywhere. But a core CPE, we're still 60% above their target. So they haven't hit their target by any means. And I think there's a risk, frankly, of seeing what we saw in 1970, in the mid-1970s when they slow down too soon and then inflation starts picking up again.
Oh, yes, that's exactly what I was going to ask you, is if this happens, do we get a resurgence in inflation?
I wouldn't use the word resurgence, frankly. There's a couple of things going on that make me think that, there's a lot going on now. Price of housing in the way they measure it in the CPI is probably going to continue coming down for a few more months. Oil is a key because obviously the price of oil helps determine, influences the price of every good in the store. Every good in the store has to be transported. So the price of oil is a factor. And the price of oil obviously is reasonably low right now. So that's a big factor. If the price of oil picks up, then I think we'll start to see inflation pick up. But at the minimum, I would say inflation is going to be stubborn, is the way I'd put it. We'll likely end the year with higher numbers than we have now.
Okay, and in terms of what the Fed is going to be up to in 2024, so no cut at the end of January, March looking pretty likely. Is it worth it at this point to try to project further than March, or is it too much?
Oh, I think by the time we come to May, they'll definitely cut. There's a lot of people on the Fed. I mean, the last Fed meeting, as you know, Powell was remarkably dovish. He didn't push back against any of the questions that he received. He had plenty of openings to say, inflation is still at prime, blah, blah, blah. And he didn't do it. Since then, as you know, a lot of other Fed spokesmen, either voting members or non-voting members, more non-voting members, but nonetheless, they've come out and suggested that, the market's ahead of itself. I agree with that. And, we still need to watch inflation. So I don't think they're going to be too aggressive early. But, once they start cutting, then the trend for the next year or so will be to cut. They're not going to cut in March and then raise in May. That's not going to happen.
And what do you think, what happens to the general stock market during this Fed pivot?
It's really interesting because you just assume, okay, lower interest rates, good for the stock market, but that's not actually true. If you look back historically, when the Fed pivots, I don't like the word pivot because it implies you go up and now go down. Sometimes you can go up and stay up for 6 months and then go down. But when the Fed starts to cut rates, it's normally because the recession is getting weaker. And so when the economy is getting weaker, and when the economy gets weaker and falls into recession, corporate earnings go down, particularly, of course, if inflation is still high. So they have cost pressures and they have demand pressures. So corporate earnings go down. So that's bad for the stock market. It's not that the Fed cutting rates is bad. It's because the Fed cuts when things are bad. So I suspect the scenario I'm looking for is we'll get a weak. I'm not looking for a crash, but we'll get a weak stock market this year. Yeah, and certainly some rotation out of the leaders, particularly the Magnificent Seven, but out of the leaders generally, and into smaller cap stocks, value stocks, away from the growth stocks.
And you were very clear in our last conversation that we will see a recession in 2024. Yeah. So I wondered if we could talk a little bit more about that, maybe the severity, the length of that.
Yeah. Well, we talked about, I think everybody talks about these long and variable lags from when the Fed starts raising rates until when we have a recession. But as human beings, when we see something coming, and this is true in life, I think, as well as in investing. When you see something coming, you expect it to happen sooner than it does. And so I think we're definitely on track for a recession. All the indicators suggest a recession coming. And, the lag period from when the Fed started raising rates until now is lower than the normal, lower than the average going back to 1950. So 1950s. So, yeah, so to say we've escaped a recession because we haven't had one yet, I think is just nonsense. It's difficult to say. There's so many people at the lower half, shall we say, with no savings and excessive amounts of debt, which suggests that the recession could be fairly long, because I think it'll be long but not necessarily deep, is the way I'm looking at it. Especially as the Fed starts cutting rates and ending QT on the balance sheet, we'll probably see a long recession, but not a particularly deep one. But it'll be painful, as I say, for people. I hate to use the word lower half. That's not a moral judgment. It's an economic assessment. People at the lower half who have no savings, who have credit card debt. Credit card debt is at all-time highs now. Credit card defaults have shot up amazingly. Discover and Capital One, which would both be seen as cards that serve the less wealthy, they've got default rates of over 5%. This is astonishing. No savings, and then you lose a job. So it's going to be very painful for some people.
And okay, so you've given us a very good idea of what you see coming from the Fed. But I wonder, to what extent do we have to pay attention to what other central banks around the world are doing?
No, absolutely. In the U.S., I shouldn't say we, I'm not American, but in the U.S., they are so, American-centric. We don't need to go into that. It always makes me laugh when you have a World Series of baseball and there aren't too many countries other than America that are in the World Series. But anyway, that's aside. What other central banks are doing is important. The U.S. is obviously still the world's largest economy, so it's important. Europe is going to have to start cutting rates soon. You see what's happening in the economy. You see what's happening in Germany, which was the powerhouse. They're going to have to start cutting rates soon. I don't see more rate hikes there. Britain is probably going to keep where they are for a little while because inflation just jumped up. But the next major move will be down. Canada, they've kept rates steady for the last few meetings. And I suspect that, there's been commentary that, we're looking for rate cuts in 2024. So pretty much in all of the Western countries, the exceptions, of course, are Japan, where they're increasing rates. I think it's up to negative 0.5% now, isn't it? Or whatever. But they're increasing rates from very, very low base. And China is also an interesting case. because China in the last year or two, a year or 18 months, has had very, very targeted stimulus, but not broad economy stimulus. I think they want to avoid cutting rates too much. So we'll see what happens there. But yeah, you're absolutely right. But generally, let's say generally the trend, other than Japan, the trend is certainly not to raise rates and more likely to lower rates. Brazil lowered rates, for example.
Okay, and we should put it all together in terms of what this means for the gold price in 2024, what you see coming there. I know that rates and central banks are not the only thing that's going on for gold, so you can mention other factors if you'd like, but essentially looking for what's coming for gold this year.
Yeah. Well, I do think the monetary factors are the most important. They're the most important fundamentally and, for any sort of long-term move. Geopolitics, as we've said before, everybody focuses on geopolitics because typically when you have a geopolitical event, gold will spike, but it's very short-lived. It's not sustained. And that's even true when it's something out of the blue, like 9/11. Gold moved up, but it didn't hold up. And that was certainly true of the Russian invasion of Ukraine last year. And this year with Israel's response to the Hamas terrorist attack, there were other things going on. There were monetary things going on. So the monetary is much more important. If we have a stagflation, which I'm expecting, a slow economy or a recession, along with stubborn inflation, doesn't have to be accelerating inflation, just stubborn inflation. Gold and other commodities historically, particularly oil, historically have been the best performing assets in that environment. If you look at simply a recession, again, you think in a recession, gosh, do we really want to own gold stocks? But if you look at the history, for the last 9 recessions, going back to the end of the 1960s, for the last 9 recessions, gold has gone up in every one except one, and that was in the 2000 recession when the European central banks, if you remember, were dumping their gold. Gold was down less than 0.5% in that one recession, but in the other 8 recessions, it was up. If you look at gold stocks are up in the majority of recessions. And interestingly, in the 3 where they were down by 2, 3, 4, 5%. The ones that they were up by 30, 50, 187%. And the other thing that I find very interesting is that the gold stocks outperform the S&P in every recession, which goes back to what we were saying earlier about, corporate earnings being squeezed. So I think the lesson from that is, if I'm right, if you expect a recession coming, particularly if you expect a stagflationary period, then you definitely want to have gold. You definitely don't want to be in the S&P, and you probably want to be in gold stocks.
And I think that answers, or at least starts to answer, kind of the question of the hour or the question of the conference, which is people who are wondering, okay, when will my gold stocks move, given that gold is close to all-time highs anyway? Yeah,
and part of that question infers the question about the disconnect. Yeah. We've had a huge disconnect between gold and the gold stocks, really for the last 11 years, but particularly for the last 2 years. It's really got extreme, and people don't understand it. I think, looking back, I think it's really quite easy to understand. You have to look at who was buying gold assets, and why were they buying. So central banks were big buyers of gold. Well, they're buying for security. They're buying for an insurance position, long-term. Well, if that's your motive, you buy bullion. Obviously, if you're a central bank, you don't buy consolidated Ajax, hoping it goes up 100 to 1. Very wealthy families in the Middle East were buying, and very wealthy families in Asia to a lesser extent in the Middle East. Again, their motives are long-term and defensive, so they buy bullion. They don't buy gold stocks. So in a way, and people don't like it when I say this, but in a way, up until let's say the last couple of months, I would argue that it was gold that was out of kilter with economic reality, not the gold stocks. The gold stocks were where they should have been. Gold should have been lower, but it was this central bank buying that pushed it up. And again, you only have to look at other things. Look at the premiums on gold coins. Flat. Nobody buying gold coins. All the coin dealers I talk to say there's no rush. So retail people are not buying gold. Look at ETFs. Money, even this last month, the gold ETFs have had outflows. So, and for the last 18 months, other than February, March last year, it's been steady outflows from the ETFs. So it's not ordinary investors that are buying gold. So it's very, very clear that gold has been propped up purely or mostly by the central banks. I forgot what the question was now, but when when you look at where we are now, the gold when the Fed cuts rates and we get to the monetary factors that are pushing gold, that are driving gold, and the monetary factors start driving, gold goes to 2,100 and stays there. You know, I'm convinced people will come back into the gold stock market, particularly if the broad market starts to wobble. Doesn't have to crash. A crash would not be good for gold stocks, but wobble, and people start to get out of NVIDIA and look for other, maybe out of NVIDIA into Exxon or something. You know, there's a bit of rotation. That's good for gold. So if we see that, I think the scenario is a perfect setup for gold. And let's not forget, gold stocks. Two things not to forget. One is gold stocks are incredibly undervalued right now. I know I said this last time, but it's even worse now. You look at Agnico Eagle, it is selling at the lowest price to cash flow multiple, other than the last quarter of 2015, its lowest price to cash flow multiple in its 40-year history. That just doesn't make sense with a great company like Agnico, good balance sheets, good jurisdictions. You know, there's nothing you can say, oh, like Barrick, you can say, oh, well, they're in Pakistan, that's why they're cheap. No, I mean, there's nothing wrong with Agnico. Gold is at over 2,000. They're making good money, and yet the stock is selling at its lowest price to cash flow for 40 in its history. Barrick is trading at its lowest price to book value, to net asset value, I should say, in 40 years. So, I mean, you know, these stocks are just remarkably undervalued right now, in my view. And let's not forget, we've been through this so many times in the past. Gold stocks can languish for a long time. Then when they take off, first of all, they take off suddenly, and secondly, the returns are dramatic. You look at 1976, 1980, the gold stock index, and I'm just on the index, so obviously there's always some that do a lot better, but the index was up 800% in those 4 years. You look at 2000 to 2008, quintupled, 2009 to 2011, quadrupled. Just look at 2020, which was a sort of recession, I guess. But 2020, when COVID came, in 4 months, the gold stocks more than doubled. So the returns when they move are dramatic.
I think that's a perfect place. We're ending on dramatic and perfect setup. I think that's a great place to wrap it up.
Oh, well, thank you very much. Thank you.
Thank you very much. Really good to have you as always, and we'll check back in and see how everything's going.
Please do.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Adrian Dig. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.